Welcome, curious minds, to another deep dive. Today, we're taking a deep plunge into some really fresh insights from the crypto world. We've got an illuminating opinion piece from CoinMarketCap, yeah, and also a collection of, well, pretty fascinating market updates. Together, they paint quite a vibrant picture of what's happening right now. Our mission for you today is, first, to unpack a really crucial concept. It sort of underpins the future of Web3. And then we'll contextualize that with some, frankly, surprising market movements and key developments happening across the crypto landscape. Think of it as your express lane to being, truly well-informed on what's bubbling up in decentralized tech.
Yeah, and what's truly compelling here is how these seemingly distinct pieces of information, you've got the tech infrastructure on one side, market sentiment on the other, how they actually weave together. It really illustrates the evolving path for decentralized technologies. We should probably start with that foundational element, right? The user experience piece.
Okay, perfect. Let's unpack this core idea then, straight from that CoinMarketCap piece. Cross-chain interoperability is key for seamless Web3 UX. So for those of us trying to navigate this space, what exactly is cross-chain interoperability? And why is it so vital for how we actually use Web3?
Right. Well, if we connect this to the bigger picture, it's essentially about making all these different blockchain networks, and there are many, making them communicate and interact with each other effortlessly. Imagine like if every website you visited had its own totally separate internet.
Yeah.
And you couldn't move your identity, your data, or, your digital assets between them.
Oh, okay. That'd be incredibly frustrating.
Exactly. And that's basically the fragmented experience many users face in Web3 today. So the piece really emphasizes that solving this is just paramount for the user experience, the UX. Without it, using these decentralized applications or dApps, the apps built on blockchains, it can just feel clumsy, disconnected. It really limits their appeal for, the mainstream.
That analogy really hits home.
Yeah.
So if it's so critical for a seamless experience, what makes actually achieving this interoperability such a persistent challenge? I'm guessing it's not as simple as just connecting the dots, is it?
Oh, you've definitely hit on a crucial point there. It's far from simple. Far from it. See, each blockchain is built with its own unique architecture, its own consensus mechanisms, its own security models. They're all different. So bridging these differences securely, that's incredibly complex work. You're dealing with varying speeds, different ways of validating transactions, and crucially, potential security vulnerabilities right at the points where these chains connect. The constant challenge is enabling that asset and data transfer without compromising the security or the integrity of either chain involved. It's a bit like trying to get two completely different operating systems, say Windows and Mac O, to run the same like highly specialized software natively and securely without any translation layer.
Okay, that puts the difficulty into perspective. So now that we've sort of unpacked that foundational challenge, getting blockchains to connect, let's pivot. Let's see how these, ambitious goals are being influenced by and maybe reflected in the broader market movements and institutional interests we're seeing right now. This is where the rubber meets the road, so to speak. First up, Ethereum. We're seeing recent reports suggesting, quote, Ethereum eyes $5,000 surge as ETF flows and charts align. And one article specifically highlighted that BlackRock's iShares Ethereum Trust, get this, pulled in a massive $303.5 million just last week.
Wow.
Yeah, and that accounted for 93% of all ETF flows.
93%. That's significant. This data point really raises an important question about institutional interest, doesn't it? And its potential impact. Obviously, these huge ETF flows show substantial institutional capital coming into the Ethereum ecosystem. That's often seen as a strong bullish signal for price. We know that. But that sheer concentration, 93% from just one issuer, like BlackRock, that also brings up a really fascinating discussion around potential centralization risks. Not in the protocol itself, maybe, but within the investment landscape around it, and how that might indirectly influence Ethereum's future development, maybe even its governance down the line.
That's a really crucial distinction. It's not just about the money flowing in, but where it's consolidating. Okay, now shifting gears a bit, let's look at the regulatory front. We're seeing some interesting legislative movement. In the U.S., Arizona, for example, is making some waves. Their Senate just voted to bring back a bill to establish a state Bitcoin reserve fund. What does a move like that signal, do you think?
Well, it really highlights this fascinating trend, doesn't it, of traditional institutions and now even state governments actively exploring direct integration with cryptocurrencies. It signifies, I think, a broadening acceptance, a shift from just pure speculation towards considering these digital assets as legitimate, perhaps even strategic holdings. It's clearly not just about individual investors anymore. The scope of adoption seems to be expanding, potentially into governmental treasuries and regulated financial products.
Interesting times. Okay, so beyond the big players like Bitcoin and Ethereum and these legislative shifts, the altcoin space, well, it continues to be a hotbed of activity, right? It seems to reflect a lot of diversified speculative interests. Some of the articles we looked at discuss projects showing notable positive price growth. H&T, for example, saw a 6.34% rise recently, and there were discussions around Magic's price action, too.
Indeed. And when we look at these smaller cap movements, the articles often suggest a kind of buildup of market pressure around certain projects. For instance, that discussion around Magic's resistance and support levels combined with volume spikes.
Yeah.
It points to periods where market participants are, intensely buying or selling. And that often leads to significant price action, one way or the other.
Right, volatility.
Exactly. It sort of indicates where speculative attention is currently focused, reflecting market confidence, or perhaps a lack of it in particular projects' near-term potential.
And just quickly, for those following other projects, our sources also touched on BlockDAG's presale hitting $313.5 million, plus mentions of XRP potentially eyeing a breakout, and Chainlink's institutional rise continuing. We even got a mention of the ongoing interest in the meme coin space, projects like Pudgy Penguins and Arctic Pablo apparently being highlighted as contenders for attention in 2025. Always lively there. So, okay, let's bring it all back to you, our listener. Why should you care about cross-chain interoperability or these big institutional moves or even the latest altcoin trends? What's the takeaway?
Well, understanding interoperability, that directly impacts how seamless your future interactions with Web3 applications will actually be. Everything from transferring assets to using different decentralized services. It's basically the plumbing, right? The essential plumbing that enables the next generation of online experiences.
Okay, the foundation.
Exactly. And the market updates we've just discussed, they provide a kind of rapid pulse check, a check on the health, the direction, and importantly, the institutional legitimization of the broader crypto space. It informs your understanding of where innovation, where capital, and where regulatory attention are flowing. This isn't just, news headlines. It's really about seeing the fundamental shifts in how digital value is being created and moved.
Wow, what a deep dive indeed. From that foundational challenge, just getting blockchains to talk to each other smoothly, to the really granular details of those huge ETF flows and the intriguing legislative pushes we're seeing, it's absolutely clear the crypto space is, well, dynamic and constantly evolving.
It really is. And if we connect this all back to the bigger picture, it kind of makes you wonder, doesn't it? As the market keeps fragmenting, with new chains, new assets popping up all the time, how quickly can the underlying technology truly adapt to keep that user experience unified, intuitive? It raises a really important question, I think, about the inherent trade-off. The trade-off between chain-specific specialization on one hand and the overarching need for, seamlessness in Web3's future.
Specialization versus seamlessness. It's a fantastic thought to leave everyone with. In a world of just increasing digital complexity, how much will that seamless experience truly define success, define adoption? Definitely something to ponder until our next deep dive.